There have been a lot of ups and downs in the market since the pandemic. The JSE went from one of the best stock exchanges in the world to being listed among the worst. But it's been a couple of years since then. So, how has the market been performing recently? Here to break it down is corporate manager at JMB, Leovani Dillon. Welcome back, Leo.
Yeah, man. Good night, Kalila. Good night to the viewers too. Everybody doing?
Yeah, we're great. And I know you are eagerly anticipating the debate tonight as well. So let's get right to it. How has the JSC performed over the last 3 years?
All right. So over the last 3 years, the JSE hasn't done so well. Of course, that's no news to anyone. So it's been a while since the market has had any good performance. So the last time was like in 2019 when we saw good performance in the market. So if I can share my screen here, this might assist with showing some of it here. So all right, so this is the so you can imagine it like this. Y-axis is the years, so going from 2019 to 2025 at the bottom, and then the x-axis is the quarterly performance. So Q1 performance would be like in the first column, right? So in 2019 you had a 31% increase in the combined market, right? So that's main, junior, everything, right? So that was the last solid year in the market. So it had a little positive 2021, a little positive 2024, but by and large, really not looking that good, right? Now, there's some themes I want to highlight. So let's go through some of the slides here and just to show them. So, all right, so this is another way of looking at it. So what this is showing is what happens if you plot the returns of a particular stock on the 3-year time horizon and on the 1-year time horizon, right? So what you're really looking for example, if you look at stock that has performed well over the last year, it would be more in this region. I'm not sure if my arrow is showing on the screen, but it would be more to the right. And if I start not performing well, it would be more to the left. So what you're realizing is over the last year, you see Carrera's way over the corner there. Over the last year, Carrera's is up over 80% in the market, right? So it's done very well for investors. So that one's all the way over there in the blue. Now, if you look on the JSE main market, so that's the index itself, what you'd realize for the year, it's not doing so hot. Over the last year, it's not doing so hot. Over the last 3 years, it's actually underwater too. Again, no surprise there, right? Now, when you look on the individual names, so remember, when we look on the big picture, it looks very bleak. But when you go under the surface, what you're seeing, you have some good performance. So you have you have the Caribbean Cement, you have the Carreras, the Scotia Groups, so the Cincos, right? That has actually done very well over the last year. And even over the last 2 years, they've done fairly decent, right?
Maybe I missed it, Leo. What does yellow represent and what does blue represent?
All right, so the blue is just the main market. The main market carve out here at the bottom, and then the blue way at the top is just highlighting Carrera's stellar performance in terms of how it maps out, right? But
and what does yellow stand for?
The yellow is just the point at where they fall on the graph. So for example, let me use one as an example. So Carib Cement here, right? Where Carib Cement is, what it's showing over the last 3 years, Carib Cement has been up about 60%, and in the last year, it's been up about 40%.
Oh, so you just okay. I thought there was something behind the choice of the colors. So you just use to highlight Carreras and the JSC
in the JSC,
others. Okay.
Yeah, as opposed to the others, right? So it's just really showing where they fall on that spectrum. Now, just to zoom in a bit, because this one is not really clear in terms of what's happening in this spot here, right? So if you zoom in a bit, you can see what's happening. So a lot of the names kind of in that space. So you have the masses, the Barritas, the GK that haven't done so well over the last 3 and over the last year, right? However, when you zoom out a little bit more, so now we're looking at 5 years out now, last 5 years performance. Again, Carreras has done fairly well. Carib Cement has done fairly well over the last 5-year period. Seprod, Grace Kennedy, Barita. So a lot of them more on the positive spectrum. So what this is kind of highlighting is that, again, in recent times, the market hasn't been so hot. However, with stocks in general, as we know, when you stay invested for a longer period of time, you tend to have better outcomes in general. So you can see over the last 5 years, a lot of them has been, flat or positive despite the downward drag in the market. But if you're looking on a shorter time horizon, like a year or so, you realize a lot of them kind of underwater. So again, just highlighting that at a bigger level in terms of the importance of Spain over time. Now, another thing to point out here, of course, one of the reasons why Carriers has done well, again, no secret, is the dividends, right? So, that's basically one of the biggest dividend payers in the market between them and probably Transjam. So they've done very well. So if you look at the dividends over time, the dividend yield, it's like 8%, or 2025 isn't out yet, finished yet. So they have more to come. But if you look back in history, it's been pretty high. And that's been one of the big drivers of the optimism around the stock. And of course, in a falling interest rate environment, their expectation that actually bodes well for them. So putting it another way, and I keep harking back to these charts because I want to, press the point of the importance of a long-term viewpoint when investing, right? So putting it another way, you go back to 2021, you fast forward, what you're seeing is that the return on the stock, the capital gains only has been significant, 144%. But when you add dividends to that, it actually adds 110% in terms of the returns over that period. And bear in mind, these dividend numbers is after tax. So it's assuming that when you get the dividends, you pay the tax, of course, got to take it out, withhold at the same time, and you reinvest it, that is what it would have earned you. So you're basically branching out in terms of the returns that you're getting. Now, looking again, this one is about, Scotia Group, right? So this is Scotia Group's history now. So Scotia Group, again, has been a decent dividend payer over time, consistent dividend payer, and they've also done well, again, if you map it over time in terms of the expected returns. And then similarly, you're seeing a similar thing with Carib Cement. They recently started paying dividends. I think it's back in 2020. 2022, sorry. They recently started paying dividends like once a year. That's a decent amount, and they're picking up the amount that they're paying each year too, right? So you can see that steadily grow from $1.50 all the way up to $2 now. So you're seeing that movement over time. So, all right, so that's it. So I just want to step back now to some of the broader context. So what we're looking at over time, yes, the market hasn't done that well, right? But what we do expect is that at some point it's going to recover. So what's helpful is that when you, of course, you have a diversified pool of holdings, but when you have holdings in that basket that have dividend payments coming in the times when the market is kind of on a lull, your ability to take those dividends and reinvest can be very beneficial in the long run, right? Meaning, so let's say for argument's sake, the stock stays flat for 3 years, but it keeps paying dividends, and you can take that dividend and keep buying more of the stock at that depressed level. And then when it does rebound, instead of you having 1,000 stock units, you might end up with 1,100 stock units for argument's sake. So when the move does occur, you have more skin in the game at that point. So again, it's just to emphasize the importance of long-term investing in a broad view, and to also be well diversified, right? It's just to highlight the importance of that in our overall investment strategy. And also to point out that while on the surface, when you look on the market as a whole, it hasn't really done so well. There are individual names that have done very well. So just to highlight some of those main points, for the viewers out there.
Okay, good to know. It's like you said at the beginning, it's been a very difficult 3 years. You pointed out some stocks that, to me, I would say that those are outliers. So you have your Carreras that you mentioned, your Carib Cement. Would you say that the market has recovered from the pandemic?
Well, again, if you look at the index itself, you can see that hasn't really been the case. But why I pick those stocks in particular, is that those stocks are actually some of the larger companies. So it's more like the blue chip names, so companies with market caps north of like 70 billion, right? So it's the bigger companies in the market. So it wasn't really, cherry pick like that. So it's just because those companies, because how the index is calculated, it's based on it's a value weighted index, meaning the bigger companies have a more sway in the movements of the market. So kind of like in the US, S&P, you have the Mag 7, which basically outsized sway on the impact of how the S&P 500 work. So we have that same kind of mechanism in terms of the math, right? But no, I don't think the market has fully recovered because, again, COVID, put a damper on investor sentiment, and then the increase in interest rates that would put another damper on sentiment. And then once that, kicks in, then persons, can tend to get overly negative. So it's kind of like, when the bull market is going, versus get overly optimistic, and then they get overly pessimistic. So it kind of goes in a cycle. So I don't think it's fully out of the woods yet in terms of the sentiment in the market isn't where it was prior to COVID. I mean, if you look on certain metrics, it's obvious. In terms of, like, if you look on the PE ratios going into COVID versus the PE ratios now, and the price to book multiples now, it's night and day. So, but like, for example, in the financial services industry, for example, going into the COVID, the multiple in general was like 3 times book, 2 times book easy. And a lot of these companies are now, they're trading at like 0.5, 0.6 book. So yeah, you can see it's just a complete reverse in terms of the sentiment in the market. So I don't think it's there yet. If you look on the ratios, it's not nowhere near the COVID levels, pre-COVID levels.
What would it take for the JSE to return to pre-pandemic levels?
I think one of the main drivers would, of course, be lower interest rates. Lower interest rates, improvement in overall profitability of the companies. I mean, don't get me wrong. Some of the companies like Sagicor recently produced some phenomenal numbers. On the 6 months period, Scotia produced some phenomenal numbers. Carrier is producing good numbers. So there's multiple companies out there that are producing good metrics, but it's just a broader basket of companies that would go a long way. And of course, lower interest rates would help fix that, because as you can understand, all else being equal, if you reduce interest rates, it spurs business activity. A lot of these companies would have debts on the book, that the rates on those debts come down. So that would go a long way to help. And then, of course, the companies being able to turn the environment, the lower interest rates, into higher profitability and revenues. So that would, I think, investors seeing that sustained would help. And then the third piece would, of course, be an increase in the dividend amounts from a lot of these companies in terms of the payments. And then that would be the third piece that I think would get persons more excited and back into the market.
Yeah, speaking of interest rates, that's probably one of the most used phrases on the show over the past years. So the BOJ recently decided to hold the policy rate at 5.75%. We've seen it since COVID go up and then come back down, start to come down anyway. How has the increase and then now the decrease of interest rates impacted the market over the past 3 years, would you say?
Yeah, man. So the increase, it did put a damper on the market, but I think it had put a damper on the market. The decrease hasn't really done much for the market, as you can see, because I think the last decrease was in May, and you haven't really seen any material change in terms of the market performance. So I think it's gonna take more than a few rate cuts in order to really get things going. So usually when the BOJ cuts, there might be 25 basis points here or there. It's gonna take more than a few, and it's gonna take some uncertainty that exists globally kind of being suppressed in the market. So as it is now, of course, there's a lot of uncertainty around what's happening in the US. Especially like with the whole tariff situation impacting interest rate decision, because even if you look on the global context, if the tariff uncertainty has basically stayed the US Fed's hand, meaning chances are if that didn't exist, they would have cut interest rates more significantly already by this point. They probably would have been down by 100 basis points. That would have given, they'd probably be down by one percentage point. So probably like, they'd be down. Once that down, they cut their rates, it gives a lot of room for the BOJ here to cut their rates. So that, of course, would have, bode well. So I think, yes, it does have an impact, but it's not point for point. So it's not like 125 basis points cut, you're going to see an uptick in the market. You need more sustained cut, and a sustained view that the path of rate cuts is almost certain. Like the expectation is that they're just going to keep coming in order to help boost that confidence. But it is an important factor, because remember, not only is it itself beneficial, but it also says something to the market when you have an environment that can happen in terms of the rate cuts, in terms of the signal. So there's multiple positive spin-offs that you get from low interest rate cuts, and it just creates what do I call it now? The opportunity cost. So how persons will look on it, for example, you have like, Mayberry on a while ago and the alpha in these higher rate bonds. In a lower interest rate environment, you wouldn't be getting those rates. They'd probably be issuing bonds maybe at 5, 6, and then you'd say, boy, you know what? Let me go invest in equities because this rate is too low. But that's the rates that would be in the market at the time. So that competition now that exists where persons look on these higher interest rates on the fixed income securities and then look at equities, that competition that dies down once interest rates come down. So it's a very, very critical piece of the puzzle in terms of the overall market sentiment. It's not the only thing, but it's a big part.
Yeah. Well, we keep tracking, Leo, in good times and in bad. We follow the market and look for the potential. Look for, how we can potentially try to make some money off of it, regardless of where we are, good or bad.
Well, let's see what happens with the JSE if we get that short selling, because that would create a different market dynamic. So that would be interesting. So I think that would be interesting.
Lower interest rates, you said?
No, the short selling from the JSE, because it's selling, that would create a different dynamic it would create a different dynamic in terms of how persons position themselves in the market.
They've been promising that for over 5 years now, and I feel like because the market is where it is right now, I don't know that it's time to introduce it.
That's the thing. I agree that now might not be the best time, but getting it ready does create a more dynamic market. Well, all right, so this is time for another show, to be honest, but this is a conversation for another show. I don't think we have time to go into it. However, I do think it does open up the opportunities for a more vibrant market in terms of, the financial products that can be created in order to reduce risk and to better improve liquidity and all of that. But yeah, that's a conversation for another time.
Yeah, I have some other thoughts on that too, given market manipulation and all things that have been in the news the past few weeks. But let's keep that for another week.
Yes.
We want to get to these debates. It's a quarter to the hour now, and we want to catch the debates live. So we're going to leave it there. Thanks for joining us.